Hey everyone, welcome to another weekly market update. It's your host, Mark Yegge here, getting ready to welcome you for a great weekend. Hope you've had an interesting week, or a good week anyway. It's been interesting. The markets are going a little bit crazy, and that's because the banking sector is going crazy. So I just saw this post that said, it looks like it's bank failure season again. I think that's really funny because, every so often, every few years, we have some bank failures. And right now we're on our fourth one. So we had, let's see if I can remember them. We had Signature, we had Silvergate, which was first, kind of crypto related. We had Silicon Valley Bank, which is basically one of the largest banks, and it was on Forbes Best Banks and all this kind of stuff. And Moody's just upgraded it like, oh, this is an awesome bank. And here it is failing. And so the government's stepping in and backstopping them. By the way, thank you, because you're stepping in and backstopping the banks. They say that it's not costing the taxpayers any money. But where do you think they're getting the money? It's from the taxpayers. And we either pay for it in higher taxes, or we pay for it in inflation, or both. And then the fourth one is First Republic. And then what you're seeing over in Europe, because they've been printing money too, we're not the only ones, everybody's printing money. You can't have something for nothing in life. And so they're printing all this fake money over in Europe, and now Credit Suisse is on the verge of failure. And so this bank, I'm going to make up the numbers because I don't remember them, but it's like the bank lost $37 billion or something like that. They need $37 billion to survive. So they turned to the Bank of Switzerland, and the Bank of Switzerland, which has lost $150 billion or something like that last year, is the one that's going to backstop them. So it's just, you can't even make the stuff up you wanted, just like most things in the world these days. Anyway, so we have some bank failures. That's the backdrop of what's going on in the market. So what happens in bank failures, everybody, is that the banks start to fail. And when other people start to see, wait a minute, that bank failed, what about my bank? They go and run their bank. Now, we haven't had really serious runs on the bank in a long time. We had some in 2008, but the financial crisis basically fixed some of that short term. It just pushed it to now is all it did. But we used to have some major bank failures back in the Depression. People were standing in lines. You've seen those black and white pictures where people stood in lines waiting for their money and they never got it. And then they put in this thing called FDIC, Federal Deposit Insurance Corporation, which insures you up to $250,000. Now, that's really fake money. So it's like if you need more than $250,000, you're supposed to not get it. Like you have to get in line and petition, and then you got to wait like a year to get it back. But the government basically just said, hey, look, we'll make everybody's deposits whole. So now, is there a $250,000 cap on FDIC? All right, I'm getting way off on this. The point is that once bank failures start to happen, people are like, where do I put my money? Can't put them in treasuries, because if interest rates go up, like the Federal Reserve Board says they're going to continue to raise rates, they're not going to, then that's going to create a depression in treasuries. And when people need their money, banks are selling their treasuries. Banks selling their treasuries, they lose, capital. People start to sense and smell that there's a problem at the bank, and they do a run on the bank, and the bank goes bankrupt. That's what's going on. And that's creating spillover into the other parts of the market. So we've had a weird market this week. And I'm going to just kind of show you some charts, and we'll talk through it. This could be one of my longer ones just because there's a lot of stuff going on right now, but I want you to see what this is all about. So let's see if I can get to the right screen. There we go. All right. So this is, you can see that we're in a red market. There's 4 red lights, and that basically means we're in a red market. Those 4 circular lights are what I call red lights. So that's showing, hey, look, we're going down, and we've been in a going down market since early part of March, like March 7th or 8th, I think was when we, this little red one right here. So it looks like March 9th. So we've been red, right? And we're still red, and now we're trying to improve on that red, but we're red. The NASDAQ composite is interesting because this one over the last 5 days has actually bounced up. Now, while all these bank failures have been going on, the tech stocks have been strangely rallying. And I don't know how to figure that one out yet, especially when one of their darling banks failed. But you can look at the other ones. The other markets are really taking it on the chin. If you look over the last 6 or 7 days, you can see there's a major decline in the S&P 500, and that's just extending the trend from 41.95 down to where it is now. The Dow Jones, same thing. It's now under its 200-day moving average, has been for more than a week now. That's not healthy, and maybe the Dow Jones Industrial Average is rolling over. I don't know. I thought we were in a little bit of a bull market, and we have been since the beginning of January, but it could be a very short-lived bull market as we roll over and maybe go back into a recessionary period. These banks have added a lot of uncertainty to the markets. The New York Stock Exchange, look at that. That is majorly down. Why? Because the New York Stock Exchange has a lot of the banks in it. So it's feeling it more than, say the S&P 500, which is just 500 stocks with techs and all that. The banks are all in this New York Stock Exchange composite, and you're seeing that really take it on the chin, way under the 200-day moving average, relative strength dropping like a lot. Not good, right? Not good at all. And then look at this. This to me is amazing, right? This is amazing. So this is the volatility chart. Now, the way you read this is the more volatile the markets are, the more people are afraid. The more people are afraid because that comes from people losing money. So when people lose money, they get afraid, they pull their money out, the markets create volatility, and then the VIX goes up. That's what you're looking at here. You're looking at the VIX going way up just in the last, say, week and a half, right? Look at it going from 18 all the way to 30 where it peaked. And now it's trying to find some footing here at the 25. That's interesting to me. That's a huge move in the VIX. That's telling us that something's going on, right? Now, I want to flash you back here to March of 07. Now, the numbers are a little different, but the scope is the same. Look at the different, it went from 970 all the way up to 20 back in March of 07. That's when we had that big, great financial crisis, and that was kind of the beginning of it. We had huge spikes in volatility. And then if you go fast forward 6 months from that, here's where it went. It went from that March period, if you go to March on this graph here, from 970, it went all the way up to 3750, right? So that was in the middle of this whole collapsing market in the great financial crisis when all these banks were failing. So could we be seeing a canary in the coal mine? Yeah, I mean, 4 banks failing in 1 week, that's pretty heavy. And when banks fail, it kind of takes a lot of things down with it, right? Remember the great financial crisis took a lot of things down with it, housing and banks and, Lehman Brothers went out of business, Bear Stearns went out of business, brokerage firms. I think, we got a lot of that stuff potentially going on. It might even be worse. And here's why. The Fed's been printing money for free for the last 13 years. I mean, the debt has gone up incredibly in this country. We're almost at $32 trillion in debt, and we're now needing to spend more and more and more money just to pay the interest on that debt. Well, that money is basically useless. It's just money paying interest, right? It's not going to giving people jobs, building roads, building hospitals, doing anything to support this country. It's just paying interest mostly to other countries that have our debt. So we are working, paying it in inflation, and that is going elsewhere, right? It's going to Ukraine, where we're sending free money to Ukraine. It's going wherever, right? But it's not coming to the people of the United States. And that's creating a problem with our GDP. And when the GDP goes down, you're going to start to see a ripple effect in a lot of things. Maybe it'll be mitigated. Maybe it won't be as bad as 2008, but I can tell you, just looking at the past, you could see those charts that I just brought up. Anyway, enough of that. I hope you have a fantastic weekend. Be careful out there. The market's red, so that means you got to exercise some major caution. Don't try to be a hero and try to pick the bottom. Just understand that the market is red right now, and it's going to turn green at some point. So when it turns green, you just have to be ready for it and then act accordingly. Have a great weekend, everybody. See you next time. Take care.